everyone. Welcome to Business Morning today. I am BC Adebayo. Oil prices are slightly up today, but still holding near multi-week lows hit overnight after U.S. data showed gasoline demand fell and recovery from the COVID-19 pandemic was lagging. U.S. WTI crude futures were up 0.72% at $41.21 a barrel in early trade, while Brent crude edged up 0.97% at $44 a barrel. Both benchmarks fell more than 2% on Wednesday, with WTI sliding to its lowest close in nearly 4 weeks and Brent at its weakest since August the 21st. U.S. gasoline demand last week fell to 8.78 million barrels per day from 9.16 million barrels per day a week earlier. And other data, such as the U.S. private employers hiring fewer workers than expected for a second straight month in August, also fears that economic recovery was lagging. Analysts warn that the upcoming refinery maintenance and the end of summer driving season would also limit crude demand. Meanwhile, the Commonwealth Bank forecasted Brent will average $46 a barrel in the fourth quarter before rising to $55 a barrel by the end of 2021. Meanwhile, back home, the Nigerian National Petroleum Corporation on Wednesday increased the pump price of premium motor spirit, otherwise known as petrol, to 151 naira 56 kobo per litre. A subsidiary of the NNPC, the Pipeline and Products Marketing Company, announced the new price a day after the Major Oil Marketers Association of Nigeria called for an increase to around 155 naira per litre. Well, the new guiding retail price took effect immediately as part of efforts to keep the downstream petroleum deregulation measures. The chairman, OTL Africa Downstream, Emeka Akabogo, joins us now to preview the impact of the new pump price. Good morning, Mr. Akabogo. Thanks for joining us on the program. Let's begin by asking you what you make of the new price of petrol increased to 151 naira 56 kobo per litre. Of course, I know that the marketers are also holding a meeting currently, but tell us your reaction to all of this.
Well, the increase which we have seen based on the issuance by the PPMC is in line with the deemed deregulation of the markets. If, as has been indicated, the government was no longer going to be subsidizing petroleum products, then at every point in time, you must have the price at which petroleum products are obtained from the markets reflecting actual costs. So what we do have is the PPMC issuing ex-depot prices for 151 naira thereabouts. I am not sure, I'm not aware that PPPRA has issued the monthly guiding price for September. So the monthly guiding price for September, which should be what should be the retail price, could ultimately be higher than that 151, which I believe is an ex-depot by PPMC. So that's the scenario. Ideally, it should be the PPPRA issuing a monthly guiding price for retail to guide the markets, by which I mean the consumers, because it's the price of PPPRA that that all petrol stations are bound to comply with. PPMC pricing probably will only just be ex-depot. So as it is, and if we recall, last month, the PPPRA did not issue a monthly guiding price. And we had a situation where it was actually the marketers themselves who took the initiative to ensure that they set some kind of pricing based on the PPMC pricing. So it is important at this time that PPPRA clarifies this pricing situation so that every one of us is clear as to what should be the guiding retail price. Otherwise, we may have a situation where the marketers are able to issue what they believe should be fair in the circumstances, which may or may not be in line with what PPPRA is intending.
But while we are awaiting clarification from the PPPRA, just as you've mentioned, now, of course, we've seen the marketers complying to this new directive. But then many Nigerians are asking the question that how justified is it anyway to increase the price of petrol at this point, especially as many are still reeling from the effects of the COVID-19 pandemic?
Well, that is a question which should be put to the government and not to the marketers. The marketers, I believe, will only respond to the price at which they get the products from NNPC, in this case, PPMC. So the government, in its wisdom, has deemed it important to deregulate pricing of petroleum products. I think the reality, and I think, as I mentioned the last time, the sooner Nigerians get to realize that we can't eat our cake and have it, the better for us. The government has realized that it can't sustain subsidies. So in the last couple of days, there's been news that subsidies were paid in the month of June. But I'm aware that the NNPC has clarified that it only paid out for outstanding stock, which was in the custody of marketers. But the point is, if the government has found that it's not subsidized petroleum products, then it means that Nigerians have to pay for those petroleum products. The subsidies, at the end of the day, have been shown by all the research available, both locally and internationally, not to be of any value whatsoever to the common man. The subsidies tend to subsidize a lot of smuggling to countries outside, to neighboring countries. They subsidize a lot of operations of organizations and persons who can afford it. They don't really subsidize the common man. So in real terms, in view of the range of all the issues which we are suffering from the COVID-19 and all the others, what is important really is that there's a bit more transparency on the part of government to broad-based palliatives that could be of actual impact on Nigerians.
Now, the PPMC had announced the new price some 24 hours after Moman had called for an increase to around 155 naira per litre as the right price. Now, with this, of course, with the announcement coming at 151 naira, how do you expect the marketers to take this? Well,
the marketers will be concerned, I believe, about their operational costs and whether the guiding retail price is consistent with the operational costs which they face. And that's why I say, even as it is, in the absence of the PPMC price, I believe, I can't say for sure, but I believe that is ex-depot. So if PPMC has set 151 as ex-depot, then if you do add logistics costs relating to trucking, that will probably be in the range of about 2 to 3 naira. Then the marketers requesting for 155 naira may actually be within range. But that's subject, of course, to whatever PPPRA eventually comes up with. So the point which I want to make is simply that if we are indeed within a deregulated pricing regime for petroleum products, where NNPC is no longer subsidizing, then this is what we should be expecting.
Oh, is there a possibility of a decline in price in the near future?
Of course, the petroleum products pricing is volatile, and global developments will determine what exactly happens. So we've had of course, you witnessed what happened with COVID, where oil prices crashed to, at a point, less than $10. And that saw a crash in prices. So we really don't know what to expect now. what will determine it is really global developments at the political and economic commercial levels. However, for Nigeria, what we should be focused on is really weaning ourselves from the dependence on the global pricing regime. And the way to do this is to have a sustainable and independent sourcing of products which is exclusively local. That will remove the foreign exchange components which drive the prices which we see today. So if all production is within country and that production is based on Naira values, then we will see a significant reduction. And I must say that this will not simply be achieved by, say, Dangote refinery coming on stream, because the Dangote refinery coming on stream will still be based on crude oil, which Dangote will be obtaining at market-based pricing. However, if there is an arrangement where we see the what we currently have, where a certain volume of local production is dedicated for use in petroleum products refining, then we may have that kind of swap arrangements between the Dangote refinery and the Nigerian government, which the operations based on a Naira-based value.
All right, Chairman, OTL Africa Downstream, Emeka Akabogu, thanks for sharing some of your time with us this morning.
Thank you very much.
In other news now, the central bank has asked speculators of foreign exchange to desist from the act and comply with the CBN guidelines to avoid sanctions. And this warning is coming ahead of the CBN's resumption of FX sales to Bureau de Change operators and Apex Bank's intervention in the investors and exporters window on Monday. Following that intervention, the US dollar exchange rate crashed to 420 Naira per dollar as at Wednesday at the Bureau de Change segment. A statement from the regulator shows that the sale to BDC will be gradual and done twice a week, as the BDCs are directed to ensure that their accounts are adequately funded for seamless transactions. The National Bureau of Statistics has published Nigeria's merchandise trade report for the second quarter of 2020, putting the total value at 6.2 trillion naira. Now, this is a sharp fall of 27.3% quarter-on-quarter and 27.4% steep decline on a year-on-year basis, as this puts the nation's value of total trade year-to-date at 14.8 trillion naira, and that represents 11.9% fall compared to what we had in the first half of the year 2019. The head of portfolio management at Commercial Partners Asset Management, Victor Aluyi, joins us now to analyze this report. Good morning, Victor. Thanks for joining us on the program. Tell us how you're digesting these statistics now.
Morning.
Of course, the import component of the data shows a value of 4 trillion naira, which is 0.39% higher year on year. But the export component accounted for just 2.2 trillion naira, and that indicated a 51.7% shortfall from the second quarter of 2019. How does this explain the trade balance deficit of 1.8 trillion naira?
Thank you very much. So clearly, this is not unexpected, given the global challenge that essentially heralded the second quarter of the year. So for a bit more context, the trade deficit has essentially widened to about 5.3% of GDP. That's about 1.8 trillion. That's coming from a deficit of about 420 billion, which is about 1.2% of GDP. If you look at the figure from the quarter one in 2020, if you juxtapose that to same quarter last year, that's quarter two of 2019, we had a surplus of about 1.7% of GDP. That's about 590 billion. So clearly, this trade deficit is on the back of a 52% collapse in exports to about 2.2 trillion, and it's clearly reflective of the drop that we've seen in crude prices, and that has affected that crude export components, which declined by about 62% to 1.6 trillion. So this is not unexpected, really. It's largely due to the global economic challenge that we have faced, the brunt of which we borne quite significantly in Q2 of 2020. So it's not unexpected. If you look at the import side, that basically rose, just slightly to about 4 trillion. So the fact that, exports have dropped by about 46%, while imports declined by just 11%, just tells us the story of how much work needs to be done to rebalance the current account situation.
And talking about how much work needs to be done and then looking forward now, when you see, given the Ghana-Nigeria trade dispute that has dominated this quarter, what are your expectations in terms of export records for the third quarter and the rest of the year?
Well, I mean, the Ghana situation is essentially born out of the whole border closure, the land border closure. And, Nigeria has gone ahead to do that, obviously for security reasons, which it continues to grapple with and continues to try to resolve. And then you add on top of that the whole COVID-19 challenge, so it's basically exacerbated that situation and sort of made it worse. But the truth of the matter is that going forward, as lockdowns are being eased, as trading activity sort of like picks up again, I would expect to see some improvement on that front. But as long as the border remains closed, I think other avenues for exports would be explored, either by air or by sea freight. But because, again, a sizable chunk of the goods that go through, essentially go through that border, it will continue to have, that significant effect on, those trade numbers.
The CBN last week directed that Form M for letters of credits, bills for collection and other forms of payment should now be only opened in favor of the ultimate supplier of a product or service. Are there advantages in this policy for Nigeria's foreign trade, perhaps for the third quarter and the fourth quarter of the year?
Well, I think what the Apex Bank is trying to do is to, part of its policy, to try and protect its reserves by ensuring that whatever dollar demand there is are actually legitimate and genuine, and that the dollar proceeds actually do go to the intended sources. So with the advent of that, you are probably likely to see some sort of decline in those trade numbers. As a matter of fact, we understand that that policy has led to a situation where a lot of banks have not been opening letters of credits, and the transactions on those Form Ms have, gone down quite considerably. So you are likely to see that come through in the Q3 and probably Q4 numbers. But of course, once that policy stance kind of shifts, considering the fact that the FX situation maybe improves going forward, that is likely to help. But with the way that it is right now, you are likely to see those trade numbers decline even further, because those are basically strong trade conduits through which the country prosecutes trades.
But in terms of imports on the raw materials, of course, sugarcane worth 43 billion naira was imported from Brazil. Considering Dangote Sugar Refinery's acquisition of Savannah Sugar that took place within the quarter, are you optimistic of a drop in sugar imports going forward?
Absolutely. I mean, the federal government has a sugar master plan that has been in the works for quite a while now, and that has led to significant backward integration in that industry. We've seen major players, backward integrate. So clearly, you are likely to see, that import element, particularly of sugar from, Brazil, trend downwards. We're likely to see that trend downwards as, the implementation of the sugar master plan gains even more traction.
Now, when you look at it now, we see that about 99% of the mode of transport of goods and products held via water, while 0.05% held via air transport. And all of that was due to the lockdown we saw in Q2. But now that international flights are reopening, how much of boost should we expect in trade via the airways?
Well, if the truth of the matter is that most of the trades essentially goes through the land borders and via sea. Not much goes through air freight. So the resumption of international flights, I don't expect to have a significant impact. However, I think that the resumption of economic activities globally, the significant easing of lockdowns should have a positive impact on the trade numbers.
Head of Portfolio Management at Commercial Partners Asset Management, Victor Ali, thanks for speaking with us on the program.
Thank you for having me.
Our commodities market update is up next in just a moment. Don't go away. Welcome back. A research analyst at the financial derivatives company Desola Sumoni joins us now to discuss today's burning economic issues at the domestic commodities market. Good morning, Desola. Thanks for joining us on the program. Well, let's take it off from where Victor left off now, talking about the NBS just released foreign trade figures for the second quarter, which showed a negative trade balance of 1.8 trillion naira. What are your own takeaways from that report, and what do you think are the implications for Nigeria?
Okay, first things first, the total foreign trade declined 27% year on year and about 27% quarter on quarter to 6.2%, tracking, developments in the global economy, as coronavirus affected supply chains and global trade. As a matter of fact, World Trade Organization, the IMF, the World Bank, all forecast double-digit contractions in global trade for 2020. Now, when you look at the exports, you see that exports declined sharply by about 52% year on year and about 46% quarter on quarter, showing the sharp contraction in oil exports, which accounts for about 70% of Nigeria's exports and declined by about 47%. But on the import side, the situation is not that dire. For quarter-on-quarter imports declined by, I think, about 11%. Year-on-year increased by 0.4%. So overall, we have a deficit of 1.8 trillion, which is deeper if you compare it to the deficit for Q1, which was about 420 billion, or compared to the trade surplus of Q2 which was about 1.1 trillion naira. So what does this mean for Nigeria? Well, one, it shows again that Nigeria is exposed to vulnerabilities in the global oil market. But more fundamentally, it underscores weakness in the external sector, which has significant implications for our external reserves as well as our exchange rate stability.
Desola, the Naira continues to rally at the parallel markets, and that's on expectations that the CBN will resume interventions in the FX market. But do you think that market participants have already factored in the impacts of the liquidity injections? And tell us what would be your outlook for the exchange rate.
Like you said, this was central bank had set expectations, and then what happened was that people that had ordered FX began to sell. But on the other hand, there's an apathy of demand because people are waiting to see where the FX rate will eventually settle. So we have a situation where others are dumping FX into the market and there's tepid demand. And that's why we are seeing the exchange rate firm up at the parallel market. Furthermore, yesterday, the central bank sold about $50 million into the private market, both spot market and the forward market, just to gauge the level of demand. So on one hand, the injection, and next week we're expecting anywhere around $60 million to $100 million to hit the market. So overall, this expectation as well as the injection is going to further cause the exchange rate to firm up at the private market. But on the other hand, we still have a lot of factors that are pressuring the exchange rate. For instance, for foreign portfolio investors that want to leave the country, we have about unmet demand of about 1.5 to 1.8 billion naira. $1 billion, I beg your pardon. And as the international flights resume next week, there's also going to be more demand for paying school fees as well as some other medical tourism and things like that. Furthermore, the sharp decline in capital importation figures as well as the trade deficit, together with what's happening in the oil market, the oil prices are relatively stable, about $45 per barrel. But also we are seeing Nigeria now complying more strictly to OPEC costs, which is going to lead to lower oil receipts. So overall, these factors put together they are showing the external sector vulnerability, and that they are going to continue to mount pressure on the exchange rate. So we are able to forecast that for September, although the exchange rate at the private market is going to trend towards the official market, we expect to trade between the range of about $420 to $430 Naira to the dollar.
All right, Desola, let's also talk about the CBN cutting the minimum interest rate on savings accounts. What does that mean, and what are the implications of that?
Well, It simply means that central bank has asked deposit money banks to reduce the interest rate they pay Nigeria. They pay on savings accounts from about 3.7% to about 1.25%. What does it mean? Well, first, it means that the average Nigerian saver would the negative return, if you take inflation at 12.8%, then the negative return for the average Nigerian saver would increase from about 8.7% to about 11% or 12%. So essentially, it's discouraging. Say people rather hold money and spend money than leave it in their savings account. But that's the low interest rate environment is also going to translate into other savings instruments. So overall, we think that savings is going to decline rapidly. But on the other hand, we have winners. One of the biggest winners are deposit money banks. One, their interest expense is going to decline, and these policies is going to be positive for banks' profitability and might also increase their share price. But if you look at the effect on the economy, I think if this low interest rate environment translates into cheaper credit for people, then it is positive, especially given the fact that Nigeria is going through economic slowdown. So if people can access, if individuals, households, and businesses can access funds at this low interest rate, then this is positive because it's going to spoil investment, it's going to spoil consumption, it's going to spoil investment in physical capital, and can potentially lead to job creation, which overall is good for the economy.
Well, let me also get your view, Desola, about this latest development, talking about the increase in the price of petrol to 151 naira 56 kobo per litre, tracking price developments, of course, in the global oil markets. What do you think that this means for the average Nigerian? Or are we likely to see more price increases in the near term?
Well, it implies that, the petroleum products, the modulation mechanism seems to be working. Tracking as price increases in the global market, we are seeing the price of PMS also increase, and the increase was about 9% increase. So for the average Nigerian, it means, well, the disposable income is going to reduce, and going to be paying more for fuel. But on the other hand, it means that transportation cost is going to increase as well, and which may transmit into food prices. So I think this increase may translate into higher inflation as well. So on the other hand, so the outlook, whether we would see more price increases in the near term, I think it also depends on what happens in the global oil market. So currently, our outlook for the global oil market is we expect the oil prices to trade anywhere between $43 to about $47 per barrel in the near term. So we think that oil prices in the global market is trading between a tight range and is going to remain in this range for the near term. So going forward, I don't think PMS price should increase any more than this in the near term. Okay.
Well, we'll still talk about oil prices in just a moment. But for now, the price of copper in the global commodities market has increased to a two-year high of $303, and that's on a weaker dollar. What other factors are driving copper prices at this time? Where do you see the prices going forward?
So copper is usually thought about as a proxy of the health of the global economy. So as the price of copper is increasing, it's giving some optimism that it's not all gloom and doom, that the global economy is actually there's recovery underway. But if you now look at the driver, you see that most of it is coming from China. So we are seeing a strong import demand for China. China is the largest importer of copper globally, accounting for about 27% of total imports. We are also seeing strong manufacturing data from China, or better than expected manufacturing data from China. Again, Purchasing Managers Index for August for China came in stronger than expected at about 53.2, up from the figure in August in July of about 52. So that is positive, and that is what is driving the prices. But also on the supply side, we are seeing coronavirus-induced supply disruptions in key producing areas. We are seeing supply disruptions in South America. We are seeing in the United States, as well as in some key countries in Africa, like Zambia. So those are the factors that are driving the copper prices. But going forward, I think that the outlook of copper price also depends on the outlook of the
the global economy, because as more and more economies begin to reopen, the demand for copper would increase. Also, if there's a strong demand for infrastructure development, then the demand for copper would also increase. So I think that if this resurgence in cases we are seeing in a pocket of economies across the world, if it's not sustained, and if this reopening that we are seeing is sustained, we see more reopening, we see more economies reopen, then the demand for copper would increase and the prices also increase.
Well, back to oil prices now. Of course, before today, in the last couple of days, we've seen prices range between $45 and $46 per barrel, but as at this morning, it was down to about $44 per barrel. Bring us up to speed on the drivers of the prices at this time and the implications for Nigeria.
Well, at this time, one of the biggest drivers is the weaker US dollar. The dollar has depreciated to a 2-year low against a basket of currencies, and again, this just makes oil cheaper for holders of this foreign currency. So we are seeing that. We're also seeing larger than expected drawdown in US crude stockpiles. Whereas the data from American Petroleum Institute showed a drawdown of about 9.4 million barrels last week, compared to expectation of a drawdown of about 2 million barrels. Then finally, we are seeing this commencement of refinery maintenance season, which signifies that the demand for oil would also be low at this time. So we are seeing, these factors are factors that was driving oil prices at this time. But now bringing it to Nigeria, again, like I said, oil prices we expect to trade anywhere between $43 to $47 per barrel. Any price increases we expect to record will be capped by resurgence in coronavirus cases and resurgence in coronavirus cases in key economies. But bringing it to Nigeria, Nigeria's oil output is also expected to decline in compliance with OPEC production. Currently, OPEC production cuts. Currently, we produce about 1.9 million barrels per day, and our production cut is about 1.4 million barrels per day. So we expect Nigeria's production to trend towards 1.4 million barrels. Couple that with oil price of about $45 per barrel. This would lead to lower oil receipts, again, which underscores fundamentally weaknesses in the external sector and would mount pressure on our external reserves as well as the exchange rates.
Thank you, Desola. Desola Simone, research analyst at the FDC. Thanks for speaking with us this morning.
Thank you for having me.
We'll be right back in just a moment. Please stay with us. Now, let's do a recap of yesterday's trading activities at the Nigerian equities market with Edidiong Iwang. Good morning, Eddie. So we see the markets are still quite upbeat.
Good morning, BC.
All right, we're hoping to get back to Edidiong in just a moment. But let's just do a quick recap of the oil markets this morning. Of course, prices are slightly up today, even though they're still holding near multi-week lows hit overnight after U.S. data showed gasoline demand fell and recovery from the COVID-19 pandemic was lagging. And WTI crude futures for the U.S. were up 0.72% at $41.21 a barrel in early trade. And we saw Brent crude edging up 0.97% at about $44 a barrel also in early trade. Now, both benchmarks have fallen more than 2% on Wednesday, with WTI sliding to its lowest close in nearly 4 weeks and Brent at its weakest since August the 21st. All right, let's get back to Edidiong for the review of the equities markets. Over to you, Eddie, again.
Thank you, BC. I was saying that the bulls seem to have a firm grip on the market, but yesterday's zone was also due to buying interest we saw on Stanbic Bank. Now, the company released its earnings yesterday, which were quite impressive, so investors reacted positively to that. The all-share index rose 0.18% to 25,460.0 points. That brought the month-to-day gain to 0.5%, while the year-to-date loss moderated to about 5.15%. The equity cap was at 13.282 trillion. I'd like to point out that this is the highest the index has gotten to in about 5 months. Now, the activity chart was mostly negative yesterday as volume declined significantly compared to what we saw on Tuesday. We had about 1.12 billion, 181.32 million units worth 1.12 billion naira, and all of that was traded in 3,408 deals. Now, the banking sector was mixed. The sector chart was mixed. The banking index was up 0.36%. Of course, that was due to gains from GT Bank, Stanbic, Zenith Bank, Wema Bank. Consumer goods was also up. Nigerian breweries was responsible for that gain there. Industrial goods was unchanged. Insurance declined 0.93%, while oil and gas declined 0.19%, and that was due to the 4.55% decline on Japan. Looking at the NASE OTC market, that sector was unchanged yesterday at 721.14 points, while the market cap was at 521.14 billion. But before we go further on that, let's talk to Abdulrasheed Momo, a stockbroker at TRW Stockbroker, for more. Good morning, Mr. Momo. Thank you for joining us on the program.
Yeah, good morning. Hi.
Well, yesterday, Stanbic Bank and GT Bank released their earnings, with both announcing proposed dividends of 40 kobo and 30 kobo each. Now, how would you assess their earnings in light of the COVID-19 pandemic?
Well, where will I start from? We've been having series of charts on the overall markets, even during the COVID-19, when market will be going down and the thing has been going up. From a technical analyst view, what I'll say is that I've been one of the people that were saying the market was going to go up despite all the issues that was on ground, because basically the market is always a discounting factor. Even before the COVID, the market has been going down all this while. So when all these things came up, everything has been factored in. And I did say that the market was going to trend because June was the last period we saw a bull rally before everything came back. Now, as of yesterday, an interesting point, which 400 levels. I'm not in the market now. I don't know what it's doing now, but we need to watch, because basically what has been keeping this steady flow of the bull trend has been the banking, this financial we've been waiting for, the Stanbic, the UBA, Access Bank, because of their interim dividend, kept the market intact till date. So as it is now, the market is what they call a double top. Now we need a strong resistance levels. If the market breaks through this trend, then I think the bull rally is generally going to continue, because from the Q2 we'll be able to forecast what the Q3 of all these countries are going to do. And the truth is that the Nigerian companies have done so well despite all the COVID-19 pandemic that has been on ground, oil pricing, the dollar to naira rate, the market has been steady. I think the help too can be coming from the banks, which are very low. And if you look at it, if you buy stocks like the banks, as I said, the GTBs, the UBAs, the Stanbic, the rates are actually higher than what the banks are giving right now. So I think there'll still be more funds entering the markets.
Thank you for your input on the program. Abdulrasheed Momo is a stockbroker at TRW Stockbroker. Well, BC, we'll hold on to Mr. Momo's point about hoping for a bullish market.
And we'll see if the bull rally will continue. Thank you, Eddie. We'll be back with you in just a moment. Plus, we'll also see what's happening at the London markets. Please stay with us. Let's cross over now to the UK, where Juliana Olayinka is waiting to tell us what top headlines are driving the markets this morning. Good morning, Juliana. The Bank of England has warned that it's impossible for large numbers of staff to return to central London and other big cities while risks from COVID-19 remain. Of course, this is coming as the government pushes to get more people back to offices across the country amid signs that activity in city centres is still sharply down on pre-pandemic levels. So why does it appear that we have these conflicting comments?
Good morning, Bissy. Well, it may appear to be conflicting, but really it's a delicate balancing act, and I don't think it's a unique situation to Britain. I think, most countries across the world that are battling the pandemic are also trying to improve the economy. And so it's an issue that Boris Johnson is trying to get over, but there are many hurdles in the way. Yesterday, the group of Bank of England financial directors was speaking to the Treasury Select Committee, which is run by members of Parliament. And one of them, Alex Fraser, as well as several others, including the Bank of England Governor, Andrew Bailey, was speaking on a myriad of topics. One of them was about the rush to work on Tuesday when Prime Minister Boris Johnson was speaking to his cabinet. He did say publicly in front of the cameras that there are large swathes of people returning to the office, and clearly that's not the case. Passenger numbers are down. We're not seeing the footfall in the high streets. And of course, this has a massive effect on the economy. There are some suggestions that with the lack of people going back to work, it could cost Britain £450 billion. Of course, that's a worst case scenario issue. But then that's potentially an issue. And some of the comments that were raised yesterday are the fact that people are, of course, still concerned about public health issues. Britain were very, very strong in March when they began the lockdown in telling people not to return, not to go to work and to work from home wherever possible. People followed those rules. As well, the Mayor of London, Sadiq Khan, was urging people, and I remember, telling people not to travel on the tubes. Millions of people travel on the tubes. How is it now safe when there is no vaccine? And we know without vaccine, coronavirus is going nowhere. So there are so many issues that the government have to contend with. And I think what's important to mention as well, particularly when it pertains to the City of London, a lot of those buildings are pretty old, pretty ancient, very crowded, very dense. People cannot work in dense, overcrowded offices in the way that they used to before. And a lot of employers are just not COVID ready, as the Prime Minister would hope that they were.
Now, another vital aspect of this issue is transportation. Of course, we've seen new figures from the Department of Transport showing that UK rail passengers were down 3 million last year, with only a slight increase in commuters rather than the widespread post-COVID return to offices that the government is urging. Does this also just reflect the fact that the people are still reluctant to go out or return to work?
Well, of course, it's exactly the same issue. Commuters, I believe, on the rail networks, about 5 million people per day were using Network Rail. Of course, if you're not going to work, we're not surprised that today, or this compared to last year, 3 million passengers are down. I think there has been a slight increase, I suppose, after the long bank holiday weekend and after Boris Johnson's determination to try and get people back into work. You did start seeing a trickle of people. I believe London's busiest stations like St Pancras and Waterloo are seeing a 60%. Passenger numbers are down 60%. So we are seeing about 40% of people going back into the office, but it's just not good enough. Also, as well, in this country, for however many years, we've had a back and forth between commuters and the government about the cost of rail fares. And there were a lot of MPs during Prime Minister's question time in the House of Commons yesterday that were urging Prime Minister Boris Johnson to start robust discussions with rail network owners in trying to, overhaul these astronomical fares. A lot of people, if you've been working from home for 5 months, to go back to spending hundreds of pounds every month to go into the office where you don't really need to go into the office, that's another big issue. But the Prime Minister did say that he is having discussions with rail networks to try and create new products for flexible working hours so people don't need to spend astronomical figures to travel peak time. But like I said, it's a delicate balancing act. COVID is still very much with us here in Britain, and at the moment workers are still feeling too scared to go into the office.
All right, Juliana, thank you. We'll have to just leave it at this point. We'll see you again in the afternoon.
Thank you.
Well, let's get back to Eddie Young for a review of the debt and currencies market. Over to you, Eddie.
Thank you, BC. Well, the bond market was mixed yesterday, although a bit bearish, as average yields rose about 6 basis points. Now, on the short end, yields rose about 2 basis points. On the long end, yields fell by about 6 basis points, while the mid end was flat. We had 25 deals worth 22.90 billion naira. Now, there wasn't a lot of activity at the Nigerian Treasury bills market, although it was a bit mixed, as we saw yields flat at 2.1%. We had just 3 deals worth 338.17 million naira. The Omo market, on the other hand, was bullish, as average yields contracted by 7 basis points. Now, on that counter, we had 34 deals worth 114.20 billion naira. But then let's talk to Olorun Toby Showemimo, a fixed income dealer at FSDH Merchant Bank. Good morning, Toba. Good morning. Thank you for joining us on the program.
Hi, good morning.
Is illiquidity in the market expected to keep rates at current levels in the near to medium term?
I would say definitely. We have quite a lot of maturities coming in during the month of September. We have about 1.26 trillion this month, as well as fast inflows and a coupon payment, which is over 200 billion. Today, we have a flow from Omo of 321 billion. That's going to boost the liquidity significantly. I expect that this inflow will keep the market will keep the rates in the market pretty low, as we will continue to see sustained demand.
So, what's your outlook for trading today?
Like I said, we're gonna see increased demand as we begin to see an increase in the Omo maturities that come in on a weekly basis. So today we expect that inflow will begin to that inflow into the market will begin to lead to increased demand by investors and by banks.
All right, thank you for coming on the program. Enjoy the rest of your day. Olorun Toba Showemimo is a fixed income dealer at FSDH Merchant Bank. Well, we'll have to leave it there on the market review. Over to you, BC.
And as always, we'll always hope for a profitable trading day. Thank you, Eddie Young. And that's where we end today's program. Thank you for watching. I am BC Adebayo.